Okay, so for our second video, we'll be looking at the grocery chain Ahold Delhaize, which is a merging between the two companies, Ahold and the company Delhaize, who merged together in 2016. So what I've done for the data of this spreadsheet is that prior to the years 2016, when they merged, I actually combined the annual reports of the two companies together. And by that way, I tried to merge the data so we could get a more accurate estimate of maybe what we can expect in the 10 years coming in the future. So having a look at their financial results, we can see here that their net sales, or like the way that a grocery chain expresses their revenue, has been growing steadily over the years. In 2016 is when they merged, so you might see a small blimp here as well, where they also actually booked quite some increase in their revenue. So what's important to know here as well is that Ahold and Delhaize, they operate grocery chains in Europe, but also in the eastern part of the United States, where they compete with stores like Costco and Walmart. Um, so yeah, the revenue here is growing on average about 3.5%, which is not something that is astoundingly high. But then again, we don't quite expect that as well, because I mean they're a grocery chain. They don't suddenly start selling a lot more groceries. Of course, people just buy what they need and not much more than that. It's not like when the economy is booming that people will start buying luxury cars and luxury bags and luxury everything. They don't really buy luxury groceries. So um, yeah, the revenue has been growing steadily, 3.5%, which is like more than like the inflation rate. So when it comes to that, I think they're doing really great. And they're doing that mostly by just increasing the amount of stores that they have available, as well as acquiring some of the smaller competitors. Interesting thing here, though, when we look at the earnings growth, we start at 2.6 billion in 2012 and racked all the way up to 6.3 billion in 2021. Now this shows a bit of a different story, because their earnings have actually been growing quite steadily and a lot faster than the revenue has. Now, again, as I always say when I look at these numbers, I like the earnings to grow faster than the revenue is, because it means that their profit margins are increasing. It means that they're becoming more effective and more productive in operating their business and are able to cut some of the expenses out that come with establishing a brand. So earnings is growing quite a bit faster than revenue, which is exactly what we like to see. Now we start looking at debt. Now what we might notice in 2016, this is when they started their merger, but that debt level was still quite low. They actually paid a little bit of debt down in 2017. That debt level have been very, very low considering most other companies in the market, quite frankly. Over leveraging seems to be the name of the game, but not for Ahold Delhaize. They've actually been very conservative with that debt level up until 2017, after which they started to rack up quite some debt in 2018, and they've been using this to quickly expand their portfolio of grocery chains, which you mostly see reflected back into the earnings growth and revenue growth in 2019 and 2020. It was an investment that they made in 2018. Cash on hand, they always have quite some cash on hand as well. Just in case they want to do any acquisitions, open up new facilities, and also as well because they're quite a big grocery chain, just to make sure that they have cash on hand in case anything happens in the future. It's like a safety thing, which is always very nice to see. Market cap has been steadily growing, but mostly speculation, so we're going to gloss over this one. Enterprise value. Now again, enterprise value is the market cap to which you add the debt and subtract the cash. It's the complete value of the company. If you would view it from the perspective of like a big competitor wants to buy Ahold Delhaize, they of course have to buy the shares from the market, which is the market cap, but then on top of that they have to also incur the debts that the company has, and they can subtract the cash from that. So like the enterprise value is the complete value of the business the way it is. And that's actually been steadily growing as well, quite in line, quite frankly, with market cap. Not much of a surprise there, because the market cap is by far the biggest part of the enterprise value, because their debt is quite low. Now moving to enterprise value divided by their earnings before interest, taxes, depreciation, amortization, and we can see here that on average they've been at about a 6.3 times multiple. Now again, and I will say this with many of the future companies as well, we're looking at a European company which is quite lower when it comes to their ratios, EV/EBITDA ratios, when it comes to American companies, because American companies are just more saturated. There's more investments going into the American market than it is to the European market. So their numbers will always be higher because they're just valued uh, at a higher starting point to begin with. So if you look actually at competitors, because Ahold is operating on the east coast of the United States, where it's competing directly with stores like Costco and Walmart, and what you see over there is that they actually operate at about a 13 times EV/EBITDA ratio, which is quite a lot higher than Ahold is. But again, that's the difference between being a American company and being a European company. Looking at the debt level, as I mentioned as well prior, it's been very, very low. Here it's even been like 0.0 times their earnings, which is incredibly low. There's no leverage here whatsoever. It's been increasing a little bit, but still, like even in 2021, which has been the highest point for the debt ever, they've been in a 2.2 times ratio. Now we kind of prefer companies to be below the 3 times, because after 3 times, the big investment banks, they will start giving out loans, but they will do so at a higher interest percentage, because of course for them it's more risky to extend a loan to a company that's already over leveraged. But that is definitely not Ahold Delhaize. They've been very conservative with their over leveraging, which makes it a very safe stock to invest in. Now we're moving over to cash flow. In the first column here, we see cash flow from operations. This is the cash money, the money that they make simply from running their business, simply from running their grocery stores and having the people buy the product inside that. This is all the money that's been made from that. And what we can see here as well is quite a steady growth here over the years. Now in 2021, what we see here is there's like a COVID blip. Now for many companies, this COVID blip actually means like a stimulus, because people had like additional money for luxury things. But for Ahold, apparently for some reason, they've actually seen a decrease in their revenue. Maybe because people decided not to want to go shop at Ahold Delhaize, because I think the grocery stores are not the cheapest per se. I think if you're looking for cheap, you're looking for more of the German kind companies like Lidl or Aldi. So maybe that had some influence there. Just looking at the quarterly reports actually for 2022, because the annual report is not out yet, and that's why I didn't quite include it into this spreadsheet. But the quarterly reports actually show a record earnings quarter over quarter every single time, and this is mostly to do with the fact that the dollar right now is very valuable, or like in 2022 anyway, very valuable as compared to the euros. Now, because they actually express their financial results in euros and they have half their business operating in the United States, of course all the profit that they make in the US is then transferred to euros, and where previously they got like 90 cents per dollar, now they get like a full euro to dollar, because they were like equal levels in terms of value in 2021. So they will see an increase in results there, mainly because of the strengthening of the dollar. Sorry, a bit of a tangent there. Moving on to the next column here, we see capex. This is capital expenditure. This is all the money that they need to put in to actually keep operating their business. It's financing their suppliers. It's financing the leases on the storefronts. It's making sure that they get a new brush of paint every now and again. It's making sure that their delivery vans have oil in them. It's making sure that their delivery vans get replaced when they're no longer that useful or efficient. It's everything that you need to keep running the business. And of course, same equal to like the revenue and EBITDA comparison. What we also like to see here is if capex is growing at a slower pace than their operating profits are, because of course, if the costs are rising higher than the profits, then it means it's a declining business. But this is not quite what we see for Ahold. So in 2012, they had 1,610 million in capital expenditures, which has risen all the way to 2,371 in 2021, with a compounding annual growth rate here of 4%. And the earnings from operations have been growing at 4%. So again, this means that they're increasing their margins, they're becoming more effective in the way they operate their business, and this is something that we like to see. Moving over to the next column here, free cash flow. Free cash flow, not free cash flow. This is actually your pro rata ownership of the company. This is after they've done all the capital expenditures and they've paid their interest and they paid their employees and all their expenses are out the door, this is the money that is left in their vault. And this is the money that's actually your pro rata ownership of the company, because this money is going directly to you as the shareholder. Ahold Delhaize has been quite steady when it comes to growing their dividend and also buying back shares. So this is what this money is used for, as well as additional investment as well, of course. But this is all the money that's left at the end of the day, and this is all the money that you as a shareholder has a right to be acquiring. So moving over to the next column here, we see shares, and this is shares outstanding. Now, it was a bit of a tricky thing actually to do this by merging the two companies, so maybe actually disregard this, because I tried to make to sum them up together, make them to equal ratios, but it's still a bit fishy. I mean, there were two separate companies prior to 2015, so maybe actually just look from 2016 onwards. Now, what we do see actually by in the grand scheme of things is that they've been diluting their share count a little bit over here, mostly to just finance the merger and making sure that all the accountancy and law things and everything that goes with a merger, because it's quite an expensive endeavor, okay? You need to completely overhaul both businesses and bring it under the same umbrella, and there's quite some logistical and financial and law implications associated with that. So, of course, they needed to have some cash on hand for that, and that's why they diluted some shares to actually try and finance that. And the same goes for 2017. Now, 2017, again, what we see in the depth here as well, up at the top, this is actually when they started going into a bit more depth as well, because it's part of their aggressive expanding strategy that they were setting up here. So they not only got additional depth, they only also diluted some shares to get some additional money for that. But what we see right away after that, once they have the money for their expansion, and they've been expanding quite a bit, and it's still they're still expanding right now. Actually, I think they've recently acquired one of the smaller grocery chains as well, I think in the Netherlands. So that kind of just comes to show that they're still very much on their expansion roadmap. But from 2018 onwards, they've been reducing their share count drastically at a pretty high pace as well. 70 million shares taken out of circulation in 2017, 2018, 80 shares, 30 shares, and about 40 shares. So they've been decreasing their share count quite a lot. And this is exactly what we like to see, right? Because it means for us as shareholders, our percentage of the pie, our percentage of the company is increasing. We get to own more of it, even though we're not doing anything to actually we're not buying any more shares to make that happen. Is because they're actually taking shares out of circulation, which is always amazing to see as a shareholder, because it really makes for some big returns when it comes to share appreciation. The next column is the free cash flow per share. Now again, this is just dividing the free cash flow by the amount of shares. It's when you get this number, which has been steadily increasing by about 9% year over year, which is in line with their earnings growth as well, which is kind of what we expected and what we very much like to see. Price per share. Now again, I took these out because it's very wacky to do that when there were two different companies, and I just couldn't find a proper way to do this, so I decided to just leave this out and only average the last 6 years, ever since they were merged together as one big entity of Ahold Delhaize. And what we see here, that on average their share price has been increasing by about 10%, reaching all the way to 31 euros and 42 cents in 2021. And I think this is about as high as it has been getting, because I think even as the making of this video, 2023 in January, the prices come down after the entire recession loomings and the inflation and all the economic fears and headwinds that were coming our way. I think this might have actually been the top of their share price. Looking at the free cash flow yield, it's been circling at around 7.2%. Now again, it was 5% back in the absolute high after the COVID pandemic. But this is a COVID blimp again, as I will say for most companies. It's not an accurate way of actually looking at the business. It was overvalued at this time compared to its previous performances. So maybe this one's a bit of the odd one out, the 5%, but on average it's been about 7.27%, maybe a bit higher than that. Okay, so now when we zoom out here and we start putting all this data into a forecast model, right? Because it's nice to know what the company's done previously, but what we'd like to do is, based on that information, try and forecast the company, see what it's going to be 10 years from now, see if we can make a prediction on exactly what the price is going to be and whether or not we should invest in this company. So in 2021, their earnings was 6,335. Now, on average, their earnings has been growing at 10.4%, which is actually quite a high number for a grocery chain. So I expect that to come down a little bit. I'm going to expect about 8% growth year over year. Now, like I mentioned, 2022 was actually going to be a record year for them because of the strength of the dollar. So this number is most definitely going to be a lot higher than 8%. But I want to be conservative, right? I want to make a conservative estimate. And if that conservative estimate actually beats the market, is when I'm interested in buying the company. Because I want a bit of safety there. I want a bit of a safety margin to make sure that I'm not exposed to too much risk when I make an investment. Because there's plenty of companies out there who I can pick instead of Ahold Delhaize, and I want to make sure that I give myself the security of picking the best one. So I'm just going to give it 8% because I don't know what it's going to do, but I want to be conservative. And I'm going to give it a market multiple of 8 times. Now, when we look historically, it's been at around 7.5, 8, 7.8, 7.6, 7.6, and then the COVID blimp of 5, which I don't think is entirely accurate. Oh, no, wait, sorry. Actually, I mean this column, not this column at all. I'm so sorry. EV/EBITDA ratio on average it's been 6.3, which has been going up to 7.2 in the last year at the COVID blimp. But we can actually see over here in 2000 and let's see, 16. Yeah, 16. It's been about 8 times. Now, again, when you look at the American competitors, they've been circling around 12 to 13 times. Now, because it is a European company, it's not valued as much. But I still do think because of the steady growth that it's been having and the steady expansion that they've got planned for the future, that they'll be going back to at least 2016 number of 8 times. So not really quite a conservative number. I do have to say, I have to be honest with you there, this is not a conservative number, but I do think they'll be able to reach this 10 years from now. So given the 8 times multiple, it leaves me with an enterprise value of about, let's see, 101 billion euros. Less the debt, add the cash, and we get to a market cap of 98 billion. Divided by the amount of shares outstanding leaves me with a stock price on average of about 95 euros and 93 cents. Looking at a different model, the free cash flow model, see exactly what we think the price will do 10 years from now based on this model. Now in 2022, I expect it to be about 1.7. Now in 2021, it's been €1.57, but it's been quite a bit higher in the previous years compared to that, mostly because this year has been quite low compared to the other years prior to it. But yeah, I'm still going to take this as like a starting point because this is where they left off in 2021. So I'm going to take this as a starting point. And they've been growing their free cash flow per share on average by about 9%. Now, to be fair, I think this is mostly influenced by the fact that 2012 does not seem to have been a very good year for them when it comes to free cash flow. Because they had quite some expenses to do over there, clearly. So yeah, I'm just going to give them 8% for the first 5 years because I know 2022 will be a very good year for them, probably a lot higher than 8%, but I'm going to be conservative anyway and I'm going to give them 8% here, and I'm going to give them 8% for the upcoming 5 years, and then I'm going to cut it down to 6% because at a certain point, as a grocery store, as a grocery chain, expansion is limited because at a certain point you'll be drowned out by competitors. And it's just a very oversaturated market as well. So I think it's quite difficult to actually grow at a high pace in the future. So I'm going to give them 6% for the last 5 years, leading up to 2031. And with a free cash flow yield of 6%. Now, historically, they've been at 7.2%. With the last year, the COVID blimp being 5%. Now, I don't think this is entirely accurate, but I do think that this is probably going to come down a little bit in the future because, again, compared to your American counterpart and compared to the performance that they've been having, which is very steady and good for the past 10 years, I actually think it's going to come up. The yield is going to come down a little bit, which means the price forecast is going to come up, which gives me about a 52 euros and 55 cents of growth rate in in stock price estimation 2 years from now. So That then brings us to the final part of our spreadsheet, which is the actual compound annual growth rate that we can expect from holding a company, a stock like Ahold Delhaize. Right now in the stock market, you can buy it for 27 euros and 38 cents, which has come down quite a bit from their COVID high here in 2021. But it's still quite high comparatively. It's higher than they were in 2020 anyway. So with the free enterprise value model, it predicts about 95. The free cash flow model, it predicts about 52, which is quite a big discrepancy, right? And I'm actually not sure which one is going to be true. So I'm just going to split them in half and say 50-50. And that means on average, I think the share price will be 74 euros and 24 cents. Now, if you project this out 10 years from now, it means an annual growth rate of 10.5%. On average, the market is always returning about 10% year over year. So what we're looking for is with a conservative estimate, and I think the estimate that we gave for Ahold is maybe not as conservative, but I think it's conservative enough that we can actually believe this number to be true. But with that, I actually don't expect Ahold Delhaize to outperform the market in the coming 10 years. And again, that's not necessarily a bad thing, okay? Because it's a very stable company. And with Ahold Delhaize, you won't see many weird twists and turns. They will have a steady revenue growth, they have a steady EBITDA growth, and people will always need to buy their groceries, okay? That's just as simple as it is. It will always be an important business, so it won't go out of business, I'm pretty sure. It's a very safe stock. And therefore, it doesn't have the growth potential that many other stocks like semiconductors or chips or like any of that will have. It's a grocery store chain. It's safe, it's good, and on average it will perform in line with what the market will do, which is about 10%. Now, if you want a safe dividend stock in your portfolio that's also buying back shares, which makes for some increased returns maybe in the future, because of course that's not taken into consideration when looking at this analysis. It's only like an additional bonus that might come on top. I think Ahold Delhaize is a very good company to have in your portfolio when it comes to like the safety of the market that might be going on, because like people are projecting a possible recession coming this year, and if that is actually true and it holds true, then I think having a safe stock like Ahold Delhaize is a good stock to have in your portfolio, but it will not outperform the market. Okay, well, thank you very much for watching this video. Please like, subscribe, and all that good stuff, and I'll see you in the next one. Cheerio!